All good. You're live.
Hey everyone, this is Carl and Eugene and Amanda. So Carol and I, we run a hard money lending business and we run a debt fund. And we get quite a few questions from time to time from our investors in regards to self-directed accounts, IRA, self-directed accounts, self-directed IRA or self-directed 401k accounts. And we decided to bring a specialist on to talk about these accounts. And today we have Amanda Holbrook with us. She's a certified self-directed IRA professional. And we are, first of all, Amanda, welcome.
You guys, hugs across the Zoom.
And we are super excited to talk to you actually about it because it's a very common question that we get from our investors that want to invest in real estate and they don't know how it all works. And as a debt fund that we run, so Carol and I, we run a debt fund and we do accept self-directed IRA accounts, we do accept self-directed 401k accounts. And I think this will be actually a very good topic to uncover because people don't really understand, nor they really know about this type of different scenarios that they can use with their self-direct accounts.
Yeah. Well, they don't know what they don't know. Right? That's it. And then the trusted advisors, you know, and professionals that they rely on, you know, if it's not on their menu, it doesn't exist. You know, so we're here to debunk that myth. So I appreciate you guys bringing this together today.
Yeah, really absolutely. Well, maybe without further ado, introduce yourself, Amanda, and let's dive into it.
All right. Okay. Just let me know and you can see my screen. We're ready to go. Thumbs up, thumbs up. Okay, here we go. So welcome everybody. So I'm Amanda Holbrook.
We are not seeing your screen yet. It's still
delayed gratification. Secret to success, right? Okay, it's loading, but I'll tell you a little bit about who I am, who we are as a team while that's getting on there. I think Zoom's just taking its good old time. There we go. Now we're sharing. Sharing is caring, right? Sorry, you'll awesome. You'll know I'm a mom soon enough. So I've been in the self-directed industry for way too long. So our company here is Specialized Trust Company. As you can see my Vanna over here, but we're a passive custodian, right? And we show folks how to invest in what they know through retirement accounts, in short. So we all love legal and they make me do this every time. So we were going to have fun with it. Nobody says you can't have fun. Ready? Specialized Trust Company is a passive custodian. We recommend or endorse any civic investor, we're not attorneys, not CPAs, not tax advice, legal advice. We're passive custodians for infotainment purposes only. Bam. You like that? You like that?
It was awesome.
Quick.
All right, guys. Like I said, I've been doing this a very long time. It's awkward talking about yourself. So I figured I would show some of our friends at networking events, etc. You know, they always say your network is your net worth. So that is how we have really built our firm and our business here, is through relationships, just like with you two. To bring the good word to folks, to let them know, hey, you can invest in what you know, you can be the bank. The stock market is not your only option. So that is kind of our superpower here with Specialized. I don't know how else to make it more simple. Okay, moving on. So for those of you that are listening, that means that you're exploring something that is, what they consider non-traditional, right? So before we can give you the solutions and the how-to and the fun nuts and bolts and meat and potatoes, you kind of got to know what is working against you. Okay. And you can think of a number of things, but today we're going to focus on these three. So uncertainty on predictability, expensive loads and commissions, and taxes. All right. So that last one sucks, right? Nobody likes taxes. Nah.
Yeah.
Okay.
Well,
All right, finish my sentence, guys.
some people do probably. Yeah.
We'll see. We'll see after this. We'll see what kind of emotions we can pull out.
Yeah, and I meant that just a quick interruption for a second, because I know some people probably are listening to us right now. And guys, so feel free to drop your questions in the chat, and we'll ask Amanda after this session all the questions, or we'll try to answer all the questions that you will send to us.
Absolutely. And thank you for manning the chat so I don't squirrel and I can keep focus for you guys. So thank you for that. But yes, we will get to everybody's questions. We forgot to touch on that. But all right, so guys, finish my sentence here. What goes up must come
down.
Down.
Yes, very good. So I'm referring to the stock market. All right. There's just no control, you guys. I mean, that's just it. You know, for those of you that have, you know, a good chunk of your portfolio or all of your portfolio, heaven forbid, in the stock market, you know, there's no real control. You know, you are at the mercy of, you know, the economy, of someone going on to social media platform and voicing their opinions. You know, there is just no control. You know, it is what I call a buy, hold, hope, and pray strategy, you know, because it is not tangible. Yeah, so diversifying the closer you get to retirement becomes even more and more important on that hierarchy scale. All right, so this is a fun one. So one of the questions that I get all the time is, you know, when someone's referred over, you know, oh, what are your fees, Amanda? Because they don't know what else to ask. And that's totally normal. So I always ask, well, what do you pay for your current account? And you know what I get, guys? Crickets. No one ever knows.
Really?
Yes, no one ever knows what they pay for their retirement account. And that's by design. You know, it's not, you know, not poking a bruise at anybody specifically. You know, it's just, it's not right there on your statement. You know, like when we're dealing in things like lending and real estate, et cetera, you know exactly what your holding costs are going into it. With retirement accounts, it's not abundantly clear on what you pay. You know, so this is, the ICI is a third-party institute. They comb all this data and figure out what the average costs are. You know, and you're looking at almost 7% right there on 100K is going to fees. And that's before the numbers that are reported to you. Because do you get invoiced for your fees in your retirement accounts? No, they just take it right out of there. That's what makes Wall Street go round. You know, so you have to take that into account, you know, when you're looking at the vehicles that you decide to use. Taxes are just everywhere. They are, and they are not going down anytime soon. And no, I don't have a crystal ball. I am basing that statement just on the past and what we've seen. You know, talk to any economist, they're looking at taxes are going up and they're always creating more, right? They're always finding another way, you know, to get us. So part of the equation, you know, it's not about what you make, it's what you keep. All right. So the key is trying to get this guy out of your deal analyzers. All right. You got to work them out of the deal. And how do we do that? We make a plan. Right. You know, you make a plan to achieve your goal, because if you fail to plan, you plan to
fail.
Yes. And that is not what we're doing today, right?
I hope not.
So the solution here is we're going to talk about, and yes, on the screen for those of you who can't see it, this is self-directed IRAs, but they should say self-directed accounts, okay? Because you can self-direct much more than just a traditional or Roth IRA. You know, everything that you're seeing here on your screen, from 401ks to health savings accounts, Coverdell educational, SEPs, simples, these can all be self-directed. Now, I don't know about you guys, but I have this conversation at minimum once a week of, hey, Amanda, I've got this account now, insert big bank name here, and it says right here on the screen that it's self-directed. Do you think you can take that big bank, a note and a mortgage, or a private placement, and they're going to hold it for you? No.
Nope.
They want to say, pick your stocks, bonds, mutual funds yourself, bucko. And that's what they call self-direction. You know, where true self-direction has been around since the 70s. So it's nothing brand spanking new, but will allow you to invest in what you know. You know, so one of the big things we're going to talk about today is being the bank. All right. So that's a power play. Now, I don't want to get too ahead of myself. Before we do that, though, there's one big, huge takeaway that I need to make sure everybody is on the same page with. It has to do with this R word right here, Roth, R-O-T-H. What does Roth mean to you guys?
Roth, you pay tax on the way in and not on the way out.
Yes, you pay the tax on the seed and not the crop. I knew you'd get that one. I always like to hear how others explain it.
Carol, 5 points. 5 points too.
5 points. All right. It's a game. It's on. I feel the competitiveness. But no, that's perfect. You pay the tax on the seed and not the crop. You guys, there's only 2 tax environments. Tax deferred, which is like you're kicking the can down the road, and at 59.5, any money you take out, you're paying ordinary income tax on. But why is that methodology broken? Do taxes go up or down? We just talked about this. They go up. So if you've got this much in your pot, but it's all taxable, how much are you taking home? A little bit less, right? But if it's all tax-free, that's what I want you guys to think of. When you hear Roth, think tax-free. And you got to say it just like that. So you smile. All right. 'Cause we all want to be tax-free. Like, that's the winning of the game, guys. When you hear of the professionals, you know, whether you're listening to podcasts, et cetera, you know, talk about tax diversification, you know, that's all this means. The more you can get on the tax-free side of the teeter-totter, the better off you will be. You know, so there's 2 kinds. There's personal teeter-totters, which are IRAs, right? Heartbeat, earned income, social security number, you can have an IRA. But a lot of our folks that we work with are solopreneurs, right? And so they are a lot of times in W-2 world. So they have, you know, their 401k with their job, you know, and they will have a, you know, called a side hustle LLC, you know, or additional revenue streams, or they're fully like self-employed, you know, and they're living off investments or, you know, whatever their active business is, you know, so big corporations aren't the only ones that get to take advantage of here. And I feel like this is one of the most underutilized or misunderstood tools. So when you hear Roth, Solo K, Indy K, Individual K, QRP, they're all the same darn thing. I don't know why they have so many names for the same thing, but they do. This plan right here is the solopreneur's triple threat. So big corporations aren't the only ones that get to take advantage of this stuff. All right. And why do corporations have 401ks versus IRAs? Deeper buckets. And you guys are like, what is she talking about? So 401ks, you can put more away in, right? I just got done saying it's not about what you make, it's what you keep, right? So if you have an entity, whether you're a sole prop, S Corp, LLC, etc., as long as there's no W-2 employees other than yourself and or your spouse or your partner, you are the solo K. But when you are your own boss and your own employee, you're both, right? But as the employer, so put your employer hat on, do we want more deductions or more deductions? Always, right? As a business owner, it's what you keep. So this is the tax deferred side. You can put 25% of your net away up to $43,500 a year. Okay. If you have a LLC and you have this side hustle, or this is your full-time hustle, and you have a once upon a time 401k IRA that's traditional, you can roll that over right to the side of the plan. Okay, so you have something to start with. Now, I know I totally flipped the script because now I'm talking tax deferred, and I was like, tax-free. Well, it's coming back. The tax-free side here, this is the piece de resistance, right? This is the tax-free side of the plan, where you can put $22,500 if you're under 50 and $30K if you're over, and that's going up by $500 next year. So we're getting a raise. But basically what that means, you guys, if you pay yourself, you can turn around and put that money right in here, regardless of how much you make. So we just went from IRAs over here, which are personal, and we're all people too, right? So you can put the 65, 70, 500 a year if you're personal, but you got deeper buckets. You see what I mean? As a business. So how does this parlay into our investment strategy, right? Especially for those that are looking at non-traditional stuff. So large contributions, yes. Tax diversification, absolutely. There's some really cool tax strategies, laddering, mega backdoor Roth. These are all things you've probably heard if you do like listening to podcasts and researching. You can do right within this plan. This is a big one. You know, so for those of us around the table that are not near 59 and a half, you know, we want some more cash flow today, right? And we've all heard about arbitraging, like HELOCs, PLOCs, BLOCs, right? Here, your 401k can borrow, you can borrow against it. 50% or 50,000, whichever's first, and it's restriction free. And you pay yourself back with interest over a 5-year period. So if you say, you know, well, Amanda, this retirement stuff's great, but I want to have my cake and eat it too. Great. Let me show you how. This is a vehicle that will allow you to do this. This is exactly why a lot of folks that are in the thick of their W-2 careers are doing this on the side. So they're using this as a catalyst to get some money in their pocket today. The other beautiful part is leveraging, which I'll touch on that a bit later.
Hey, Amanda,
Sure.
what is so if we go back one slide, what is the minimum interest rate that people have to pay themselves if they borrow money from
Perfect.
401k?
So it's like you did not see my slide deck, but that's
Oh,
a perfect tee-up question. I got
excellent.
you. Great minds.
Excellent. Excellent.
So here's how the 401k loan works. And I always like to just put this out there so that folks are thinking of it. Because I think it's an underutilized, I know it's an underutilized tool. You know, we don't think of this as something you can use for investing. Just like if you're not in the right circles, you don't think of your lines of credit, et cetera, in that fashion. So the price that you pay yourself back, so it's 50% or 50,000, whichever's first, guys. And that is not a specialized trust company limit. That's a Department of Labor limit. Okay. You pay yourself back at prime +2 over a 5-year period. So it's a fully amortized 60-month loan. So if you want to figure out what that looks like, you know, there's calculators on like bankrate.com, things like that, that you can figure out what that is. So what can you use those funds for? It's restriction free. So arbitrage it, use it to make cash flow, use it for capital, use it for private lending. You can use it for education, marketing, the list goes on. You know, you will hear some that will say, oh, I'm using it for debt consolidation, et cetera. With rates as high as they are, you know, that can be viable depending on what your financial house looks like. You know, but majority of our clients are using it in that let's make some money today mindset.
And I think Carl and I can speak to this a little bit because so our debt fund invests into real estate, right? So we lend money to real estate investors who fix and flip houses. And we also have accredited private investors that we pay high yield returns to. And the investors that invest with us, they come, the majority of them, they have self-directed accounts, right?
Mm-hmm.
And they do basically private lending with our organization, with our company. And so just to your point that, you know, like private lending, I see private lending on your list, and, you know, this popped up to me because this is what Carl and I do. And people that invest with us, some people understand and they invest with us, some people don't, and that's the reason why we are having this webinar right now.
Yeah.
But this is actually a great list, guys, that Amanda that Amanda has on her slide. So I think definitely you guys have to take advantage of that. And if you don't know much about like, what it means or how to do it, that's why we have Amanda.
Yeah.
Right here.
Yep. I would say I'm going to show you those steps. That's so simple, and give you some scenarios too of like what I've seen other clients do in debt funds, because it's a matter of getting over that mindset shift of, oh, I can't touch my retirement. Look, if you're sitting there and your professional that you're relying on to make sure your retirement is there is telling you weather the storm, it's cyclical, ask yourself, why are they telling you that? And secondly, why is that an okay response? If you go to your doctor with a health problem or cancer or whatever it is, and he tells you weather the storm, are you okay with that response? No, because you're going to be the number one defender of your health. I want you guys listening to have the same attitude about your finances, about your retirement. If there's not a better option on their table, go look on another table because it exists out there. That's like what what's offered here. That's where it's not what it's who right, guys?
Mm-hmm.
Another important life lesson. They just keep coming. Size does matter. What do you guys think I'm talking about? In retirement accounts, ha 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 ha. But I'm talking about other people's money, you guys. OPM, which is for all of you that invest in real estate, we are talking about other people's money, right? So when you're thinking of your own retirement accounts, what does that mean to you? Like, how does this work? What side of the fence are you on? Okay, so I'm going to share this number. $37.5 trillion are in retirement accounts in the United States. That's last year's stats. Okay. The market's taking a beat up, so I'm willing to bet it's gone down a little bit, but I will tell you just under 12 trillion of that are in IRAs. They're not employer plans, which means you can self-direct them today. If that gives you how big of a piece of a pie is out there, there's a reason that's why Wall Street goes round the way that it does. Now, ask yourself, if you're looking at your returns on your statement and you're like, man, I can do better than my broker, this is your time. Be the bank. What do I mean by that? You can be the bank. That's what Eugene meant when he says they have a hard money in a debt fund, is they're being the bank. So who's the bank, Eugene? Is it you or is it the investor? It's both, right?
Mm-hmm.
That's exactly how that works. So I want to get to that. I'm going to pause right there. But here's my other sentiment, because think of your own retirement. And this is where, for folks that utilize self-direction to help educate and build their business, and I'll challenge you guys to this too, throw this out there on your social media and see what kind of response you get. Do you think anybody's going to respond back and say, oh, I'm tickled pink with my retirement account earnings? No, they're mad. Like they see they're ripping open statements or they're, e-statements, and they've got tears in their eyes because I've lost 50, I've lost, 100. I mean, I've seen large numbers. I look at statements all day, every day. You have control to stop that bleeding. It's called diversify. So what does that mean? You find a better vehicle. You find a better opportunity. So if some of this is resonating with you, this is where I want you to do a screenshot. Okay. So this is a little bonus I put together because I hear these types of accounts all the time, but you may be hearing me say IRA, and you're like, well, I have a TSP from when I was in the military. Well, thank you for your service. But a TSP, for those of you that have never seen one, that is a thrift savings plan. That is our government's version of a 401k. Roth IRAs, traditional IRAs, some call them rollover IRAs. That just means it was a 401k once upon a time. 403Bs, or a lot of our teachers have 403Bs, or they have PERS plans. Like I'm in Ohio, so we have OPERS. California is CalPERS. 457s are very common with our county workers, our police officers, our firefighters. Qualified annuities, Roth solo case, simple DB plans, inherited IRAs are a big one. You know, if your grandparents or your uncle has left something to you in the form of an IRA, you know, you can continue to invest it. It is not stuck where it is. So if you can make more money for it, and if it is a Roth, you just hit the tax-free jackpot of early retirement right there. So that's one of the most, I think, just underutilized, because we think like, oh my gosh, I can't touch it. You know, it's like the golden goose, right? Can't touch it. Health savings accounts. I've had 5 different conversations. One was just earlier today on health savings accounts this week, and it's what, Tuesday? Because folks are looking at figuring out different buckets before year end for putting money away. And health savings account, we're all healthy, right? We all take maintenance. So if you have a high deductible health plan, you can have one of these. You get a deduction for the contribution, and it grows tax free, baby. That's huge. And you can use it for expenses today. So if you've got kids, braces, expenses that go 3 years back, like all are covered. Anywho, you can self-direct all of those. So this is, you guys, I never have like a good segue into this one. So I get this question every time. So I just bring it out there on Front Street. How does this work? You just decide you want to do it. Everything's done via DocuSign. I do the heavy lifting. You fund the account. So we do a transfer. Again, my team does that. And then you do a deal. And that's where, you know, I can't tell you what to invest in, but that's where we co-educate with rock stars like you guys, because you have the opportunity, right? You know, and that's it. 1, 2, 3. It is not rocket science. So here's what 1, 2, 3 looks like, guys. And this is what you were getting to earlier, Eugene, is so if you have an opportunity, what does that look like? And this is the same paperwork. So you use the same investment paperwork for someone that's using cash, their personal name, an LLC, or an IRA, correct?
That's
it doesn't
correct.
change for you guys. Here's the difference, guys. So you have a self-directed account. The secret sauce is the name of the account or the titling that you use on their paperwork. That's it. So Carl, I'm going to pick on you because I haven't said your name in a while. So instead of just Carl, it's going to say specialized trust company custodian for benefit of Carl's Roth IRA or Carl's 401k. That's the secret sauce. So it goes out, the funds go from our firm, and we do a verbal verification of wire before they do, security measure. They go to the closing table, they are placed in the fund. Now, if there is a refi or it's sold or you exit the fund, where do your profits go? Or if you're getting, what are your guys' payouts? Are you paying out quarterly, annually, monthly? What does that look like? So I'm using a live example.
We're paying out monthly.
Okay. So paying out monthly, even better, especially for those of you that are listening that are closer to retirement. Where are those monthly payments going? Right back to the retirement account, 100% tax sheltered. If it's a Roth, it's tax free. So I want to hit on this again. So what you just told me is that you guys are sending out consistent, predictable payments on a monthly basis to folks' retirement accounts.
Correct.
Or their pockets. Okay. So for those of you, especially closer to retirement, what do you want to get out of the rat race or to retire? You want consistent, predictable monthly cash flow. Yes? Do you see where the connect the dots are happening? Now, if you are in the stock market, we just went over, you have no control. Do you know what types of vehicles you're being told? And it's so hilarious, as I do calls like this all the time. And there's one couple, and it's so funny because the husband's kind of very analytical and the wife's just, this is the way it is. don't you get what he's trying to do with you? And I just love it because their banter back and forth. It's totally an opposites attract scenario. So I'm just sitting there and I have no poker face. So we're on a Zoom together and I can't help but smile. I'm willing to bet when you guys sat down, he brought up something called an annuity. Like, oh my God, how did you know that? You know why they bring up annuities? Because they give you that consistent, predictable payment. But what do annuities pay out?
Not much.
Not much at all. Like less than 3% or less. And then they lock in that sucker. But they sell you on the consistent, predictable payment that you're going to get for so many years. But it's not hedging inflation. So you're just going broke a little bit slower, right? I mean, because the time value of money, that's not going to do it. And you're still risky. And if you change your mind, they hit you with this surrender penalty for moving your own money. I'm sorry, you're not going to charge me for moving my own money. Like, that is not okay.
Yeah, I mean, so it sounds like the annuities, when they do annuities, they lock people in for a long period of time. They pay a specific they pay specific interest rate to people, like 3%, right? And if inflation goes higher than 3%, they still lock to 3%. If inflation, if inflation is below 3%, they make a little bit of money. But if it's like right now, between like 6 and 7%, then they're losing twice as they're losing a lot of money. Their money are losing a lot of value.
Yeah.
Right?
Yeah, they're in the negative.
Yeah,
they're in the negative. So I had a gentleman that and he went into a debt fund, and here's how he looked at it. He had saved up a 7-figure account, and he said, look, I need consistent, predictable income, and this is the amount I need per month. So you know what he did? He took the whole thing and he's got it working in a debt fund, which, you guys, is secured by real estate. It's backed by tangible assets. I'll let you guys touch on that. So he is now getting a consistent, predictable income into his retirement account, tax sheltered, right? He's not paying any taxes on it. Of his return, he only needs half of that to support his lifestyle. So he's got even another cushion building on the inside. And because he is over 59 and a half, we call that turning 21 all over again. He's taking out consistent monthly distributions. And why I say 21 all over again, guys, is because at 59 and a half, there's no slap on the wrist by Uncle Sam. So regardless if you're still working or not, you can take money out of your account and there's no 10% penalty. All right. But that right there took so much stress off of his shoulders, because beforehand he was constantly just looking at his account. I mean, how many of you listening have just look at your account all the time, and you see the yo-yo and it just gives you anxiety, or you clench your jaw? It's just bad news bears, right? Because there's no control. What you guys are doing is the complete opposite. So I want everyone to kind of think of what that is full circle, because it's more than just the math. So I'll ask you guys this. So worst case scenario, all right, I always paint worst case scenario for folks. And I know I sound like a negative Nancy. I'm not a negative Nancy, but you always look at your exit strategy. So if someone wanted out of a fund, what does that look like?
Carl, you want to take it?
Yeah, I'll take that one. So if they've been in there for more than 6 months, they would just submit and ask that we'd like to remove our money. And then 90 days later, we would either send a check back, or if it's in a self-directed account, we would send that money back to the self-directed account.
Simple.
So easy exit strategy. All right. Like so in the stock market, stocks go bad, it goes down, but you guys are lending on tangible assets. So you're playing the bank. They are funding the bank, and you guys are playing the bank, correct?
That's right.
Yes.
So for those of you listening, what is the biggest building in every city? It's the bank. What does the bank lend on? Property. What are the 3 basic needs of every human on the planet? A home, which is property, right? Why do you think banks lend on property? Because it is a tangible asset with a structural value as well as land value. It appreciates over time. It's also insured. So what is the worst case scenario? You know, so this is where, and maybe I'm very old school, but you kind of do your little T-square. Do you know what I mean by that? I don't age myself, but like
Our pros and cons.
yeah, pro and con list. Yeah, that's exactly it. No, I'm showing my nerdiness.
All good, all good.
But that's I get this question a lot. And because I have to educate, I can't advise, you know, it's really just walking through, you know, how do you analyze and make the best decision for you and your family and your future? You know, so this is the diversification play, you know, and it's just so logical to me, you know, because majority of the things that I hear, you hear, you know, yes, I want to build my retirement, but I'm doing this for my family. You know, I want to leave to my kids, or I'm trying to build stuff up for my kids. You know, it's very seldomly I get someone on the horn that's, you know, hey, I'm just super selfish and I just want to build my account so I can have the biggest account ever. No one ever says that, you know, like that's not the why. And you do coaching, like that's not the why for folks. You know, it's for the bigger picture, right? Perfect segue. So, you know, I'm sure you guys are kind of the same, cut from the same cloth, and like us here at Specialized, we do this for our families too. You know, I'm not just sitting here preaching to hear myself talk. You know, those are my crazy little Holbrooks at the bottom. That's Keith Marsh and Edwin Kelly. They're the founders of Specialized. Literally, Edwin was my first mentor. Keith and I go back to like kindergarten, like in grade school.
Really?
Okay.
Wow.
Yes. I've got stories. I will
Hey,
not share
is that you on the first row? Second picture?
Which one?
The little girl in a dress.
That's Keith's little girl. Yeah.
That's Keith's little girl.
Yeah.
Okay.
That's Keith's little girl. Yeah.
Okay, cool.
So my point is like the spark that initiated this firm and our team was the same reason, or the why. If you guys, I'm sure you guys have read like Simon Sinek, Start With Why, you know, that every client I talk to tells me about. It's, you know, you want more time, you want financial freedom, and that's become such a buzzword, you know. So how we've been able to do this is just through conversations just like this with great minds of saying, hey, there is a better way, you know. So meeting with one person, one family, one business at a time, and giving you those tools to live that, you know, and I hate even saying this one, but that life by design, you know, like God put us on this planet to give back and to live a more fulfilled life, not a balance number on a spreadsheet or anything like that. You know, so financial freedom doesn't give you all of that happiness, but it does give you, it makes it easier, right? You can't drink from an empty cup, you know, so it allows you to put yourself in a position to give and share with others. So whether that is monetary, time, knowledge, you know, and those are the big, I guess, cores that I always want to touch on. Is I've been in corporate, you guys know my background, you know, and corporate gets too corporate, it rubs me the wrong way. You're working with people just like you. We're doing this for our families. There was another reason why I was showing you pictures of my children that were professionally done on a recorded Zoom. Why was I doing that, Carl?
Because we all have families, and then we can have a family Roth.
Yeah, you know, well, I'm paying those kids. Why am I paying my children? Am I violating child labor laws? No,
I think you want to save on taxes.
Yeah, I want to save on taxes in the company. I also want to make sure they have tax-free, you know, income forever, you know, but they need a heartbeat, earned income, and Social Security number to have that Roth. So they're making that money, baby. You know, everyone always asks because my kids are younger. But you get them involved, right? You know, so pictures are one way. You know, we've had them sanding walls, raking leaves, you know, on properties. It's very easy to get them involved, and they want to be involved. Nothing says you can't comp them for being involved, right? So this is one of those like very high level strategies I always like to touch on, because you talk about legacy. And if you've been to enough events like I have, you know, it is not like the, hey, first 5 people to the back of the room strips me this big check and you get the special sauce. You know, that's not the deal. Like, I hate that. It drives me insane. Just show me how to do it and don't break my bank to do it. So that's where we came up with like our family plan. You know, we have an all-inclusive platform, whole families included, but you still come up with the problem of, man, I've got to do, if you got 5 accounts, that's 5 deals a year you have to source. You know, what is your guys' minimum for your fund?
We're at 20,000 minimum.
20K minimum. Okay. So if I didn't have, you know, 5K a piece in here, like, or I only had, you know, say 2,000 on the kiddos and a little bit more for mom and dad, could I do the deal? How do you do it?
Is it coming from one account, or is it coming from 5 different accounts?
So 5 different accounts.
5
So
different
if
accounts.
you want 5 different accounts, that's going to be either some really long titling, or you just partner them together. LLCs are great for that. You know, this is where
we can do it. We can do it.
Yes. So you basically partner all of the accounts together. So when you look at that operating agreement, it would say specialized trust company custodian, FBO, mom's account, dad's account, et cetera, et cetera. And then you have checking account at the bank of your choosing, and then you would just invest from this one LLC. But my point here is, on our team, we're always educating about being creative. You know, how can you get everything to work together cost effectively so that everyone's getting a return? You know, so anywho, I'll get off of that, but this is just, you know, you can see again my nerdy flow charts. You know, this is how we work with our clients to just help them get on that right path. Even if you're not there today, you know, it's not a matter of if it makes sense, it's just when, because we're going to get this guy out of our pocket. I've got a screenshotter for you. So we're coming up on year end, which also requires some maintenance, right? It's not just tax deadline, you know. So here are some highlights. Okay. You want to determine if you have a champagne problem. Okay. And I'm not saying, like, you know, have some self-reflection if you drink too much champagne.
I was gonna ask, like, what is the champagne problem? Because is it similar to a wine problem, or?
I know I have more of a red Pinot problem, not champagne. No, I'm joking. But no, it's if you crushed it and it looks like you're going to owe taxes. All right, that's what we call a champagne problem. You've done so well, now it's like, crap. How do I keep more of what I'm making? You want to see your CPA before the end of the year, because like the solo K, you have until tax filing deadline to contribute, but you want to get it open this year for the employee side. Are you compensating your children? You know, are there, you know, obviously we don't want to pay out third parties if we can help it, but keep it in the family. Why not? You know, do you have personal buckets set up? Like I said, I've had 5 conversations this week on HSAs alone, you know, and these were all referrals from a great CPA, by the way, because they are having these conversations. They're following the list without me telling them. It's awesome. A Roth conversion without paying taxes. Do you guys know what I mean by that one?
Is that also known as a backdoor Roth?
Mm-hmm.
Oh, wow. Look at you, Kyle. Nice.
He's at 10 points,
Yeah.
Eugene, just FYI.
Yeah.
Eugene's got to catch up.
he got 5 more points. Good job, man.
But yes, a backdoor Roth, you guys, is regardless of income when you switch from tax deferred to tax free. Okay. When you do that, who do you have to pay in the middle? Uncle Scam. All right. So the key would be, what do you have going on outside of the retirement account that can cancel those taxes out? And the reason why you want to do it now in fourth quarter is because you have to have it done before year end. You know, so this is a best practice that you can do every year. Hey, Mr. or Mrs. CPA, can I do a Roth conversion this year without paying any taxes? You should literally be emailing your CPA that every fourth quarter. Just make it your annual best practice, put it on your calendar, make it automated. We all love systems, right? Do you need more capital for next year? Look at the 401k loan. Even if you're in W-2 world, see if your company allows for that 401k loan. That's a DOL rule, guys. They can restrict it, but they all have to offer it initially. Okay. So I want to make sure we're not spending too much time on that, but they want a step-by-step plan for themselves. So as I mentioned before, I'm a giver, especially 'tis the season. So what do we give except our time? All right. So you've probably seen my Vanna here, but this is a link to my calendar, guys. You know, if you have questions or some of this is resonating with you, just hop on a call. I'm about as approachable as they come, you know, and Carl and Eugene are always able to take your calls as well. If you have more questions about what they're doing, you know, or how the two can marry together, or would this make sense for me, or I'm not quite sure, you know, at least get a plan together. You know, that's what this is all about. You know, there's no stupid questions, you know, just hop on a call. We'll have a conversation. Scary stuff.
Awesome. Awesome.
All right. So this is actually, I'm a nerd. You guys know this, and I'm not a techie person, but this is it's like a contact app. It's called Blink. So if you wanted to save a contact card instead of, you know, putting Amanda IRA chick in your phone with like the screen here, that's the way it will download right to your phone. Okay. So it's your money. It's your future. I want you guys to do it your way. Now that's what this is all about, my friends. So we're going to open it up to questions, because even though I promised I wasn't looking at the chat, I was seeing some things pop up. So I know there's some there. So we'll go there. I'll leave this up as we tackle the Q&A part of the talk today.
Awesome. Amanda, thank you so much, first of all, for the wonderful presentation.
Of course.
So many gold nuggets in that presentation. And I think what we're going to do, if you don't mind, we're going to, you know, save this recording, and we're going to have this recording available to everyone who did not come today, and to everyone who actually came, so they can watch it again. Are you good with that?
Oh, absolutely. It's
Cool.
You always pick something up. You pick something different up every time. And I know I talk fast, so I apologize.
Awesome. Well, so I think we have a little bit of time, and I think we may have a time to answer a few questions. And if you guys have more questions, like Amanda mentioned before, you know, feel free to talk to Amanda. She was very generous and provided her QR code, and so, you know, just scan it, book a meeting with her, and pick her brain, because she's absolutely fantastic. Okay. And yeah, I mean, so we have a few questions. Why don't we just go and answer those questions and see if we have time for a little bit more. But if not, you know, our doors are always open, right? So to answer more questions. I see one question that you know, I'll probably start. I see one question that is just, you know, popping up right in front of my eyes. So the question is, if I have an old 401k account, how long does it take to transfer?
So great question. So old 401ks, that's the qualifying event, guys. So you can move an old 401k at any time. You know, even if you rolled it into your new plan at your new company, those old funds are always eligible to be rolled out. But yeah, 2 weeks or less is all it takes. Yeah, so I do the paperwork for you. You know, you give me a statement, a copy of your ID, put a nice pretty bow on it. My team goes to work for you, and it's usually 2 weeks or less. You know, I give you a wider window because every other company has different processing timelines. I mean, my cheat sheet, I think, is like over 5,000 now for other institutions.
Wow.
Nuts. But yeah, we keep tabs on all that internally.
Wow. Cool. Carl, you want to take another one?
Sure, I'll take one. Amanda, if I have a TSP, can I move this to a self-directed account?
Good question. So I know I touched on this earlier. The TSP is like for our military and government employees. So if you are no longer active, this is the key, you are no longer contributing to TSP, you can roll that over. And great news, they have finally got it all online. So it's easy now. So TSPs actually since 06 that the Roth component came out for the solo K I explained, TSP adopted that, so a lot of TSPs I move have tax deferred and tax free. So you can move all of that into a solo K or a traditional and a Roth, or you can move part of it. You don't even have to do the whole thing if you weren't quite sure yet. So yeah, those are great. It's a much easier streamlined process than it used to be. I'm not going to lie. It was a little bit higher on the PETA scale before, if you know what I mean by PETA scale. Do you guys know what I mean by PETA scale? You're looking at me, Carl, like, or you're laughing at me. I can't tell.
Is that because it was harder?
Yes, it was a pain in the arse.
Gotcha. So the key with that one is you have to be separated or retired from the military for that to work.
Yeah, you do.
Okay.
Good one. Any others? No, we good? I don't see the chat window.
Eugene, do we have another one? I think I have one here. If I have a current 401k, can I move that into a self-directed account?
Good question. So current 401ks. 401ks have something called qualifying events, guys. So either you're 59 and a half or you don't work there anymore. Pretty simple. If you do work there though, I want you to write down this term. It's called an in-service rollover. So reach out to your current provider and just ask them, say, hey, does our plan allow for an in-service rollover? Now I want to prep you. A customer service rep will be the one answering your call. They are trained to tell you no. So if they tell you right away, they did not look, because every plan is literally written differently and it's a big document, so, hey, appreciate your time. Can you send me that in writing? If they say yes, it's usually all or a percentage of your vested balance you can roll out while still being employed there under 59 and a half. So it's always worth checking. And worst they're going to do is tell you no. But it's always good to know about your plan. They're all made differently. So there's no one universal answer, but there is a way. So just a little bit more legwork to find that one out. Good question. That's a common one.
Yeah, that's a good one, because we're going to have a lot of people that have current 401ks that aren't happy with what they're getting and want another option.
Yeah, it kind of sucks. Like, it's like you're trapping your money. It's like, like, what do you mean I work here and I slave away for you guys and I can't take my money? Like, this is so wrong. The other thing too, the 401k loan I mentioned, ask them about that too if they tell you no on the rollover. Yeah, hey, can we do a restriction-free loan? Don't tell them what it's for. They don't need to know. It's restriction-free. It's literally in the name. If they take you down the rabbit hole of, oh, is this a hardship? No, I just want a restriction-free loan. That was very popular during COVID, the CARES Act thing.
Interesting. Well, I think we have a time for one more question. And so one question that we currently see in our chat is about so Amanda, what happens if I lend money and they do not pay?
Good question. So it's the recourse, guys. What does a bank do when you don't pay your mortgage?
Take the house.
They take the property.
They take the asset. So what do you guys do if someone doesn't pay?
We take the property and then we sell the property and then we get the money back.
Yep. So your worst case scenario, if you lend money into a fund and then they lend money to where like the borrower doesn't pay them back, life happens, whatever, they're going to take the house. And then what they're going to do with the house, they're going to sell it and they're going to make a profit on it. So you see, and especially more so than a bank, because you guys are savvy. You're not going to sell that house on like a fire sale foreclosure. You know, you're going to sell it for a profit, pretty it up, whatever you got to do to get your money back. You know, because you wouldn't have lent on it in the first place if the numbers didn't make sense. So that's where, in working with experts, you know, it's even more safe for you guys, you know, because this is essentially like private money lending, you know, except you have them as your experts analyzing the deal. You know, they're playing the bank and the underwriter, you know, and you're benefiting from it. So I guess it's even a bit more passive than private money lending. Is that safe to say? Yeah.
It is.
This is usually, guys, I mean, everyone always asks me, when people self-direct, what do they put their money into? You know, private money lending, I will put this in that category, is, you know, most likely the highest that we see, because it's the most passive. You know, that's where people will start to dip their toe in the water. They're not going to come in and say, ooh, I just watched HGTV and I'm going to flip 5 houses because I only want, you know, I want to do this part-time and I want more time freedom. No, that's not time freedom. Like, that's a job. Like, that's like the opposite. So
Yeah.
no, I think this is great stuff. I love that you guys are putting all this info together. I hope everyone that's listening here got, you know, at least 1 or 2 nuggets. And I just wanted to personally thank you on behalf of myself, Specialized Trust, and the team, you know, for getting this together. And, you know, look forward to, you know, helping all of you guys out that are listening here in any way, shape, or form that we can, in self-directed ways.
Awesome. Well, I think it was very, very good and very, very informative. Thank you so much, Amanda.
All right. 1, 2, 3. Cash
And
flow.
I think Carl is the winner today with 10 points.
10 points. Cash flow,
I'll take it.
Carl. Oh, that's marketable. I like it.
Do I win one of those champagne gifts?
Yes.
Awesome,
Yeah,
guys. Thank you. Thank you again.
let's do it again. You want us to say 1, 2, 3 cash flow?
Yes, let's do it. Ready?
Yeah, let's do
1,
it.
2, 3.
Cash flow.
Cash flow.
Okay, no, come on. We have to do it. We have to do it again. Come on, all together at once, at one time.
All right, you count.
Simultaneously. Okay. Okay. 1, 2, 3. Cash flow.
Flow.
Okay, that was kind of bad.
We're better at doing
Okay,
the
so
cash
no
flow.
karaoke with this group.
Yes.
We're not karaoke.
Okay. Yes.
I want to see a t-shirt next time I see you that says #CashFlowCarl.
Awesome. Well, guys, well, Amanda, thank you so much for joining. It was awesome.
All right, guys. Thank you.
Yes, and for everyone who joined us, you know, thank you very much for being with us. And we're gonna send the recording to you. And if you guys have any questions, we're gonna leave our emails and phone numbers as well. So feel free to reach out anytime. You know, Carl and I and Amanda, you know, at least like Carl and I, we don't charge for consultations, but Amanda also doesn't charge, at least for the first one. But yeah, so I think it was very good. And if you guys have any more questions about how you can actually utilize your self-direct accounts or non-self-direct accounts, and you want to convert those accounts to self-direct accounts, you know, Amanda is your gal. So feel free to reach out to her. And with that, I think we're gonna finish our webinar, and we're gonna say goodbye. But I'm sure we probably, if people want, Amanda, if people want to do part 2 and maybe have like more in-depth webinar, can we do it?
Yeah, absolutely. I'm game.
Awesome. Well,
All
gang,
right.
it was awesome. Thank you very much for jumping in, and we'll talk soon.
All right. Bye, guys.